Hi, I'm Keith McCullough, and welcome to day 2 of the summit. We get to kick off with somebody that I'd just love to spend some time with away from you. I could spend some time with this guy all the time, going all the way back, Buddy Carter. You just reminded me, we've known each other for 13 years. At that point, your son was a teenager. My son was, knee-high to a grasshopper. You came all the way. This guy, for all of you that don't know the history, and many of you have complimented him, and we're quite excited about this conversation, as you should be. You came all the way to New Haven. You're like, look, I need to know more about this, just as you would. You're super successful at Goldman, and that was your living, right? It still is your living. You make money. You have to save the money you made, and you have to compound returns upon that. So I'm looking forward to going through, mostly parts of your process, but it's a really good thing to have you back on Hedgeye TV and have you at the summit. So thanks for joining us.
Well, I would say thank you for having me. It's always a pleasure to be here. I always try to say something that at least is slightly valuable to somebody. And for those that are not familiar with the story, I had a very, very successful and good friend in the hedge fund industry, and he somehow got one of your first early looks in early 2009, and he sent it to me, and he said, it's really interesting. Now, this was a very accomplished person, and he said to me, when I read what Keith writes, I hear you talking. You guys should meet. So I remember calling you, and I remember thinking to myself, there are just so many overlaps. That original early look that I saw, I think was a black background with white text, and it had color. And that was at a point where, again, when I showed up at Whitney Avenue, you and I, and it was you, said we are literally standing at the start of a gargantuan industrial-sized information arbitrage opportunity. And that's exactly what it was. And, we've been friends for 13 years now. Hard to believe.
Yeah, it is hard to believe, but it's an amazing thing, life, in the sense that you never quite know who's going to show up at what point in time. It's a lot like markets. It's the particular people that show up and the particular things in markets that happen at particular times. But to me, I was like super grateful. I was like, wow, I'm not alone. I mean, you and I look at things similarly but differently. And I want to get into that. I want to get into how you look at the world. And start with, we're going to stick to the slides that Buddy prepared, which I think is going to be highly valuable to many of you. This is not, it could be a business school presentation, it should be, but in business school they don't teach you how to trade the way that Buddy Carter knows how to risk manage his capital. So let's just start with optimism in the face of uncertainty and tell people about what you mean about that.
Sure. Well, my last time at Hedgeye, it was lost in activation. And the activation function is the mechanical transmission of input data into output mechanics, meaning buy, sell, send. So I thought, and certainly over the course of all the times that we've been friends, and we've talked, just enormously over the last 13 years, the challenge for everybody is there's so much input data now. There's so much opinion. There's just, the world is awash in loud, editorial, low value content. So the whole idea of, and one of the slides in that presentation was, the 2006 to 2008 Netflix contest, which they offered $1 million to data scientists around the world to come up with a 10% improvement in their Cinematch, which was the recommender system for movies. And the reason on the cover of my last, kind of segment here was Napoleon Dynamite, was the movie Napoleon Dynamite was the most polarizing information for them to recommend. If you like Napoleon Dynamite, what would you like next? So the world literally has moved so far from that. And it was a data science team from AT&T that literally figured out that people change the way they rank movies, the way they rank genres. So there literally has to be an ability to learn over time from the data in order to make better choices, hence enjoy better outcomes. So the slide that you just put up, I wanted to start the idea, optimism in the face of uncertainty, the idea that we're all on a journey and we all have to be able to control ourselves to the extent that you have to have some type of input process. You've got to have some kind of mechanical digestion of all the data. And then you've got to have an effective way to deploy and retract capital. It's as simple as that. There was a great book that I read about 20 years ago by famous Ned Davis, Being Right or Making Money. It really is all about making money. One of the first things you and I talked about in 2009 was I was very frustrated after the great financial crisis played out of financial reporting, because as you and I talked about that first day, everybody can go on TV and say something about the market that can't be construed as wrong later on. And that was the point of Hedgeye. That was the mission of Hedgeye, to be able to give you uncomfortable information at a time that it's most appropriate. Does that make sense?
It does. I mean, to a lot of people, I think it wouldn't. But in Hedgeye Nation, it absolutely does. I mean, there's a distinct, and at this point, I think a distinguished difference between the way that the game is laid out to be played on CNBC or wherever else, and the way that it's actually played with real money by the real players that survive, right? And there are a lot of human, there are a lot of human frailties and faults that kind of come into play all the time, because we're hostage. I have this book that, A Flaw in Human Judgment, called Noise, which you've most likely read. Sure. By Daniel Kahneman. I mean, we're still, like, since you and I started talking, well over a decade ago, we're still at the point where the tools are becoming better at a faster rate to mute our own human noise and get away from our own, like you called it, addiction by design on the slide that we have showing right now. Like, there's a unique ability today to do what you and I were not able to do yesterday. Like you used to say, I think you said this to me, you said at Goldman Sachs, I'm pretty sure this was the one-liner, can you make money by yourself in a dark room? Yeah, I can. You can. Not everybody else can. And that's highly augmented today by the things that we've been given through technology, which are many things on that page. You want to talk about some of that?
Sure. So when you interviewed Annie Duke, I'm not sure how long ago that was. I hadn't read her book, Thinking in Bets. Yep. Now, I was familiar with her story, but it's an outstanding book. So the two books I read in order to prepare for this were Thinking in Bets by Annie Duke, and then Addiction by Design by Natasha Schull. And so they're both dealing with chance in a completely different way. When you and I think of all the differences, the way the media has become so effective at producing desired outcomes for them with respect to the people that consume media, I thought Addiction by Design, which everybody should read, it's an amazing journey, just like Annie Duke, of understanding the machine as it's looking at you every single day. The Annie Duke book, and again, you alluded to this in your conversation with her, is, and again, I'm paraphrasing, but at some point early in the conversation, you said, when I was playing athletics at the highest level, I really wouldn't be able to tell you why I did what I did. Now, that's a very simplistic description of 10 to 25,000 hours of repetitious grinding. But that's the point. I would say the people that I would hold in the highest regard in the investment business over the last 40 years seem to truly be at their best and the most calm in the worst circumstances. Not their first rodeo. They were prepared. So again, the one thing that has been consistent, you and I have talked about, and all the things that we've talked about over the last 13 years, is how to put yourself in a position to be as effectively prepared to compete every single time you go out. It's never been harder for people to keep themselves away from all the media that is it literally is designed to influence their perceptions. They don't even know it. So when you read a book like Addiction by Design, it's almost unbelievable the thought that's given to influencing the people that play slot machines. It literally redesigns their perception of the possibility and probability of winning. I just thought there were a lot of parallels to the the financial media today. And when you go back to October of 2020, when Jim Chanos was talking about the ridiculous TAM valuations of things like FanDuel and DraftKings, and he said, just take a look inside of a casino. Usually, the largest amount of square footage is relative to the amount of profits. It's all slot machines. And when you look at the amount of square footage just given to the sports book, it's tiny. So we live in a world where people are being influenced at a greater rate than they ever thought possible, and they don't even know it. I thought that was an important thing to start off with.
Yeah, real important to start with. And let's go to the next slide on the learning journey. What's most interesting about it, to me, of the many interesting things, I don't know if it's the most interesting thing, but it certainly is interesting, is that everything that you just said is just happening more and more and more and faster and faster and faster.
No doubt. Right.
And then you take a big deep breath. Like again, here you're citing Benoit Mandelbrot on this slide, where he took a breath. It was just the machine was, everything was happening slower back then. You remember he when he was at the IBM Research Center, he had whatever massive mainframe, and he's studying cotton prices and Brownian motion, et cetera, et cetera. Sure. It's the same conclusion today, the same premise, the same premise to my process today as it would have been back then. This guy was a bloody genius, obviously, and throughout the 1970s and 80s, he continued to prove it out through the lens of fractal math. But it's still today as distinguished in terms of a starting point than it ever was. I think, amidst all the noise that you're talking about, the noise, that Danny Kahneman just, I don't know if he won another Nobel Prize for the book or not. So why did you pick this quote in particular by Licklider?
So he literally, the last time I was on Hedgeye, and we were talking about the activation function, how do you design and make sure the mechanics of the way you make decisions are appropriate for the environment in which you're now living.
Yes.
Relentlessly evolving. You and I work harder today than we ever did on Wall Street to try to literally just stay slightly ahead. And the reason I picked this is, again, back in 2019, in October, when I was at Hedgeye, you said to me, it's clear the machine learning of today stands on the shoulders of giants, and it's one long process. That's exactly right. When you go back, Joe Licklider, he literally got a PhD in psychoacoustics. He literally was the first person to institutionally and scientifically think about influencing people that hear things to do something other than what they may have wanted to do. It was the start of surveillance capitalism. So you and I have always talked about a learning journey. You and I have always talked about how to be aware of things that are changing around you that could be detrimental to you. And the worst thing in the world is literally to show up at your computer in a fleece vest and think that you know everything. It's the worst thing in the world. So I just thought it was interesting. This comment is from 65 years ago. It's as true today as it ever was, but people have a far more difficult time of concentrating today. That's why I wanted to start with this.
I mean, it's harder to start from ground zero today if you knew nothing than it would have been when I started Hedgeye.
1,000%.
There are ways, and I'll look at anything that gets right down to somebody trying to tell me about the chart of Solana or pick up some kind of a popular crypto, and I'm like, no, that doesn't make any sense. I mean, it's almost like Hope.com was created by Michael Saylor, obviously, who's the evangelist for Bitcoin, to make you not think about anything. You will hear, and Mike Green said this yesterday. He said, in what world is everybody proud after the fact of 60 to 85% drawdowns of their capital? He's like, that's not the real world. That's not like if Buddy Carter, you left and you went, you did it on your own. You raised your kids, you raised your wonderful family on your own capital. I mean, could you afford a 20% drawdown? Never mind 60 to 80 in HODL?
Well, I used to say to people, I've got enough money to do what I want. I just can't fly private, and I can't lose half of it.
I can't lose half of it.
Well, I mean, but that's it, because you and I know your disposition for decision quality, and that's the other reason everybody should read Andy Duke's book. It's all about decision theory and decision quality with massive amounts of uncertain information, and how to put yourself in a position to make a material financial decision, not knowing like what you really should know, but you've got to do it.
Right.
So everybody should read those 2 books. They're fascinating.
Another book that everybody should read, which is your next slide, is A Man for All Markets. Now, this guy also, and not ironically, started gambling. I mean, it's not like the rules of gambling, the margin of error is actually, I would argue, I wonder if you agree or disagree with this, but I mean, I can make a lot more money in markets with much better odds than I can gambling. But some people can make some money gambling, and correct me if I'm wrong, but isn't that where he started?
So he's a physics PhD, and he had the belief that mathematics would allow him to beat games of chance, which was heresy, which was literally, and he sought out MIT's Claude Shannon, who's the father of information theory, the father of secrecy theory, and literally he and Alan Turing are the 2 foundations of the digital world that we live in. So Ed sent him a letter and said, I'd really like to work with you to see if I can prove this out. And Fortune's Formula is the name of the mathematical paper that he wrote outlining his belief and how he was going to do it. It turned into a monstrous success. And he wrote Beat the Dealer, which everybody should read. And then he wound up 25 years at Princeton Newport Partners, and his statistics of win rate, and it's just out of this world. So again, this slide is important because it is the foundation on which you start to think about assembling the components to make better decisions and enjoy better outcomes. This is the foundation. This is it.
Yeah, 100%. I love how you use the block letters there for effect. I mean, most people absolutely do not understand risk, reward, and uncertainty. I mean, this is, I called it Hedgeye risk management for a reason. I mean, we don't call it Hedgeye pump and dump, Hedgeye crypto moon bubble laser eyes. It's called, again, there's a, and God willing, everybody that's made a pile in those types of securities or whatever it is, I'm glad for you. Just don't lose half of it, like Buddy said. That would be a very bad thing.
Right.
And you don't want that to happen to you.
Well, it changes your decision making.
Well, it absolutely does. You make, and you've said this multiple times, you make precisely the wrong decision at the wrong time, which is why I think we could go through so many of the books that you and I have read, and I really do believe that I've stood on the shoulder of many, many giants. I mean, as you know, I try to read a book every 10 days, and every time I crack the next one open, I realize what I haven't known the whole time. And that's because, as you continue to go forward, you see new things develop in terms of whatever you're reading, new learnings. But you can also go backwards and to the 1960s and see where you should have really started. And to me, it's just it's a wonderful profession on many levels. But one of the most, I think. I guess one of the things I'm most grateful for is just the ability to wake up every day and bloody well learn something new. That to me is critical.
When you think of this, you started at CSFB, is that right?
Yeah, on the trading floor. It was a madhouse.
So,
1990s.
It was literally like Friday night in a Chinese restaurant, and people would. My mother would say to me, "How do you know what's going on?" I said, well, fortunately, I was a bartender in college. I've got a good memory and I can do more than one thing at one time. And that literally, when you think of what the calamity, the cacophony, you heard realized volatility. Now you hear nothing, you see nothing, and there's more episodic danger around every corner that most investors have no idea. They're not scared because they don't know it's there.
Yeah, well, that's it. I say this all the time. I mean, it's not what you're looking at on your 50-day moving monkey that matters. It's what you see. Now, again, just go back to 2 weeks ago. You could have made a pile of bad decisions chasing 5, 10, 50-day moving monkeys because you thought the charts were shaping up, and then you just got body bagged, and the same things you got body bagged when Quad 4 started. So, I mean, let's start with, people know about my process. Let's talk about how you've built some of your own screens. This is a great slide that you called, build your own winning window. I love this picture. These are not the types of things that people are looking at when they're looking at a simple one-factor 50-day moving monkey, by the way. What are you looking at?
Well, this was literally designed to be an image. At some point, Mario Gabelli, your friend, was on Real Conversations. And he talked about you start with data. He said, we assemble the data, we array the data, we analyze the data. He said, it's not a 9-to-5 job, it's a 5-to-9 job. Basically, have fun storming the castle. It's all about the data. So one of the things, again, that old Goldman Sachs, how much of the money that you made today would you have made in a dark room? And I remember telling the story. At one point, I was on Hedgeye. I met Ken Tropin of Graham Capital. Mm-hmm. And after about a half an hour of talking about a variety of different things, he said to me, you seem like a really good guy. I know you've been very successful, but you seem like every other successful bank trader that I've ever met that made money because of where you sat, not because of who you were. He said, and by the way, I'm trying to be constructive, not critical. And sometimes it's the way somebody says something, not exactly what they say. Well, he did me the greatest favor in the world because I was pretty successful. I did go from a bartender to, a pretty successful guy. And all along the way, it's like I used to say to people, we were successful in my old world is because we had a far better than average understanding every day of where the market was not going to go. So we're going to talk about true random number generators. We're going to talk about, and the science of gambling is really interesting relative to the science of, here we are, we're trying to combine the art of trading with the science of risk management and just win, baby. So it's far harder than anybody ever thinks. Everybody thinks that, well, I've been doing this for a while. I've got a much better than average understanding of what's going on. So good things should happen to me. And then they don't.
What a great lesson. I mean, and he's built. He's obviously super successful.
He was awesome.
Ken Tropin being of Graham Capital. These, maybe take a step into the flow, because sure. when you're at Goldman, and when I was at Credit Suisse First Boston back in the day, that sure. noise in the room, like if you were good, I always say that I wasn't smart enough that I could hear. Like if you're too smart sometimes, I've seen people in this game that are way too smart. They overthink everything and right. they can't get to the point. The flow of a room is critical. Now we can capture the flow in other, I stand at right. my desk after the macro show, I stand in silence. Everyone here can tell you that. And you're not really supposed to talk to me for an hour and a half. I don't talk to anybody. Anybody between in the hours of the wolf, 4:30 until right. I write something. It's complete silence and all data. Now, when you have this slide that shows, guys, pop it up, he calls it flowing. This is, where today would you position what I just said in terms of like the ability of your tools and your machines to capture anything that you want to talk about in terms of flow versus the flow that I just alluded to?
Sure. So the slide that is showing now, this notion of an energy cascade, turbulence, the momentum of turbulence, nothing is more important in my background than understanding open, high, low, close. Remember, you don't know most of it until the end. So, the sequence of days in a time series, I grew up in a world, I'm not too sure what the amount of volume my hands had a role in transacting, but it's an enormous amount. So the idea that we would see the imagery of turbulence via transactions, spot transactions, forward transactions, options transactions, all had a little bit of information content. But the reason this slide is important is because it's the foundation of the way heat input goes travels through a market. And I thought it was really interesting because when you think about it, you and I absolutely know the first thing we really connected on 12, 13 years ago was at that point a volatility generated expected range. It's the heart of thinking about today's weather relative to the weather that we've had, and then how to handle yourself as the weather evolves over the course of the day. This is really important. As we know, central banks, monetary authorities, and other large organizations have never had more macro scale impact on the energy cascade of markets globally. That's just a fact. And understanding that's the underpinning of the way turbulence roots itself over the course of a day, I think is really important. I know when I first heard you use the term flow, I think it had to do with your hair. I didn't know that.
Well, that's when my hair was all not gray. I mean, it's a long time ago, man.
Right. As Louis said to me at one point, "You're all salt, no pepper." I said, "At least I have it." So
that's good. I like that.
But this notion of flow, the game for you and I is always understanding if you've got a way that can better or average predict the range of a certain period of time, then I absolutely want to know what type of flows are going to come into that range, when they're going to come in, and what impact they're going to have.
Well, that was an initial learning. Like when I met you first, compared to what I think I know about that equation today, is very different. I mean, the machine has perpetuated at such a pace. You know, the proactively predictable nature of regimes of volatility when you have like a jump condition into the next, you know, like I think about these volatility buckets, it's amazing. You know, yesterday and today, for example, in the S&P, it's like my jump condition number on just using a simple one like the VIX, I think was 2388. The minute that we shot through that, bang, you tanked the close. And then you broke down below it. This morning on the open, boom, they rip them on the open. So it's the conditional factoring in volatility space, to me, Mike Green, to you, so many people, that is really, to me, of all the things that are like most interesting today versus 12, 13 years ago, I think that's being highly amplified by the machine and all the market participants, all the leverage. On that, you have a couple slides on, you know, clock time versus market time.
Sure.
If we get down to like, you know, most people tell me, hey Keith, if I read any of these books that you've told me to read, like Mandelbrot, people like they can get through that one. Misbehavior markets but Jim Gatherall, you know, the volatility surface, no bueno. Like that's not, you know, and he talked a lot. Like when I read that for the first time, I think it was written in 2006. I was like, shit, I don't know shit about volatility. I mean,
right.
And that to me, so what is it about clock time, market time, et cetera, and knowing, you know, when the range has changed? Because most Hedgeye Nation people are like, what do you mean you didn't tell me I didn't know the range that you publish in the morning is different than the one in the afternoon. I'm like, no shit. Why do you think I have real-time alerts? I'm showing you the window of that changing.
Right. So, you know, when I first started really putting myself in a position to be far more effective in a dark room relative to what I had been in my career, I was very fortunate. A friend of mine who had worked at Tudor for a long time gave me a risk manual of theirs. And it literally, and I've given it to many, many, many people. It's 33 pages of how to use realized volatility as a base level input for the way you handle yourself over the course of time. Now, of course, they're in leveraged discretionary trading. So it may not be appropriate for everybody, but the realized volatility, the change in the volatility surface over time, of course, impacts your capital. I would always tell the story the first time I had dinner with Stan Druckenmiller. I sat next to him and I said to him, Stan, could you tell me about your investment process? And he looked at me and he said, yes. He said, I bet 8% to make 25% and try to stay in front of the mutual funds. I said, thanks, pass the butter. So when I got back to the office, pass the butter. So to me, it was just incomprehensible. And literally, he only spoke in basis points.
Yeah.
So when I got back to the office, they said, what was Stan like? I said, he's really tall and he talks in percentages. That's it. And it's the same thing today. So, you know, everybody's got to be really careful about taking in too much information that just doesn't help them. They've got to go on an information diet.
You got to reduce it.
They really do.
You absolutely have to reduce it, and you have to amplify, you know, the healthy components of your diet. So you have to have, you have to have an awareness on where that range is. If you don't have an awareness on, that's why the quad is so valuable, because the quad is a forward-looking item that the range is constantly reflecting on. But Druckenmiller, by the way, the slide, guys, that says control versus cowbell. We have a bunch of, actually, maybe if you want to, add on that, reality, courage. These are the kinds of things that he'd talk about.
Right, and the one thing I would say about the last slide, again, taking data and conforming it into a normal distribution, so you desequence it. What you do is you decontextualize it and you devalue it. When people say 67% is one standard deviation, but that is desequenced events, and if you're talking about close-on-close volatility, it means absolutely nothing. And the one thing I'll tell you is 1994 was a very, very difficult year in global fixed income. It was a very, very difficult year at Goldman Sachs. And there was one person who had a terrible day in fixed income one time, and one of the partners was very agitated, and he said, "What happened?" And the guy looked at him, he said, "You don't understand. It was a 7 standard deviation event." And the guy goes, "Yeah, F you, where's my effing money?"
Yeah.
So, when Stan talks about control, you need to be focused, you need to prepare. And by the way, in the most extreme conditions, you need to be able to control your own emotions. And it's far from a layup. So, again, this is a person who, gets a lot of notoriety of being one of the best investors ever. And everybody talks about him as if it would be easy to have a conversation with him. Not true. I always tell the story. One time I was talking about something, literally 30 seconds in, he said, "What's your point?"
Yeah.
That's it.
Yeah, he was one of the, initially, he was running institutional money when we started Hedgeye. That meeting, that you better be ready for that meeting. You better know where every single part of that discussion can go, and you better deliver that wood, or you're not going to get paid or have another meeting. So that was
not to be trifled with.
No, I mean, it's like, when you're playing at the highest level, that's a different notion than somebody creating some company on Twitter saying that they're playing at the highest level. That's not, you can't play this game at the highest level if you've not traded it with real ammo. Let's start with that.
But that was the point about your anti-Duke conversation. Like when I was at the highest level in athletics, I literally couldn't have told you why I did what I did. Longtime president at Moore Capital, Louis Bacon's company, Elaine Crocker, who started at Commodities Corp, always used to say, when we ask our best performing PMs why they are successful, they can't answer the question. But they show up every day, they do the reps, they literally, as I always say, call an important person on the weekend early, you'll get them, they're up.
Yeah, I mean, look at this slide, guys, the sine curve that he has on, that's alluding, Kareem Abdul-Jabbar's alluding to Larry Bird. And you find this a lot in sports where you can't get, when we bought the Phoenix Coyotes, I had a meeting with Wayne Gretzky, and it was a very, he opened the door to the hotel room, he's like, "Hi, I'm Wayne Gretzky." I'm like, "No shit." But it's like, it's not,
a great one.
If I asked him how he scores goals, he probably couldn't, articulate it, he'd probably say, I don't, people, there's so much, like you said, so many hours and so many reps and so many experience, such a body of work that somebody like Larry Bird, I think is that who he's talking about in this quote? Is this
Bird.
Yeah. I mean, anywhere where he knew exactly where he was shooting from instantly. And he's already shooting the ball. It's not, I get it. I tell kids in hockey this. Expect the puck. And as soon as you're expecting to get the puck, you already know what your two options are when you're moving the puck. You're either shooting the puck or you're passing the puck. You don't wait till you get it, take 2 stick handles and have a coffee. That's not the way it goes. And in clock time and market time, you absolutely, in the most critical moments, do not have time to overthink. You can't.
Right. And the great thing about Bird is he's probably still not given the credit he deserves for the totality of his talent.
Yes.
The sheer immenseness of his basketball IQ and the way he got it done. Remember, as Pat Riley said, if I want somebody to take a shot to win the game, it's Michael Jordan. For my life, it's Larry Bird. And all you have to do is literally go on the YouTube and search for Larry Bird trash talking. You will laugh your ass off. I mean, he literally He literally told people, I'm going right there. There's nothing you can do, and I'm going to shoot it in your face. And when he did, and he won the game, he said to the guy, I didn't mean to leave 2 seconds on the clock.
Yeah, people think that I need more gravitas on Twitter when I chirp people. I don't have much time in the day left. How about this Heisenberg? This is a really good one, guys. Show the Heisenberg. People are this is good. Why did you use this?
Yeah. So this, to me, like I said, you and I met under circumstances. It was March of 2009. The right way to go forward was far from apparent to almost everybody. And I was literally interested in the way information was composed, constructed, delivered. That's why you and I immediately hit it off because, again, I hadn't been a dentist in a prior life. I had a lot of real experience. And for anybody that has seen Breaking Bad, Walter White is probably the most unlikely, fierce guy you've ever met. And the whole notion is calling himself Heisenberg and the idea of location and momentum. Keith, this slide is what you and I have talked about for 13 years.
I love that. That's
literally.
So good. So good. I just learned something I definitely didn't know. That's awesome.
And you and I have to work tirelessly to get to be better predictors of both momentum and location. That's it.
So let's take, we don't have a ton of time left. In fact, we have 12 minutes. So for the rest of the slides here, can you fire through them just to give people, the sense of what you're looking at and what these things mean?
Sure. So this literally, it's a buy-sell function that a friend of mine, it was a public document, it was written by an engineer, and literally it's a breakout trend following system where you're long if a certain amount of criteria show up and you're short. So the interesting thing for me is I was never interested in a strict systematic buy and sell system. I was interested in a market weather vane that would indicate the better than average understanding of when medium-term passive trend followers would seek momentum. Mm-hmm. My belief was over the course of time, momentum would never go out of fashion. People would always look to be longer the market that was going up faster, be less long or short markets that were going down faster. And this has been a very, very effective way for me to have a politically agnostic input into my system. It warns me, it's like constructing a series of seesaws. So the seesaw being the slope of the market. And you and I know that people are always following the slope of the market. Mm-hmm. And so what I use this for is when the weather is going to change, combined with the expected range calculation that I offered out on Twitter, on Hedgeye, I've gone through it. So it's all about the trend of the market and then the volatility. So that's what this slide is. Mm-hmm. And by the way, this has you long since 2005, 65% of the time, and short 35% of the time. But the real secret is the 35% of the time when the market isn't long, according to this system, volatility is 50% higher, realized volatility.
Yeah, it's a big conclusion. Because again, that's the whole point about volatility. It changes your behavior. How about the daily average? I think this is daily. You're using daily average range here on the next slide, and then using a bunch of statistics that you've logged.
Okay. So what I wanted to do is I wanted to look. Anybody can do this. You can do this for anything. As you and I have talked about, when you look at close-on-close volatility relative to actually range dimension volatility, and this is average true range, which is a series of larger deviations. And this literally is the difference between daily average true range and daily close-on-close volatility over the course of since 2005. And the reason I did this slide like this is it's hard to get any intelligence from this type of sample. This just means that over the last, I think it's 18 years, every day there's been 53 basis points of range outside the close-on-close. Does that make sense?
Yep. Does.
Okay, so the next slide. is this is just the distribution of those. So literally 95% of all the records are less than 175 basis points. But by the way, that's an average, and that doesn't tell you anything. So literally, this is a very normal frequency function that I'm telling you doesn't tell you anything. So the next slide is I think this is so go to the next slide. That's just so this is literally by up day, by down day, and that doesn't tell you anything. There's more green, obviously, but there's nothing intelligent about looking at this sample over time. Now the next one is actually interesting. Now this is by phase. Now remember, the market is long 65% of the time and short 65% of the time. And this is when all the fireworks happen. Those red amplitudes, those red accelerations of the difference, daily excess volatility, daily excess variance. And by the way, when you look at this, between February 24th and February 28th of 2020 was extreme excess daily variance. What we didn't know at that point in the S&P 500 is that's when Bill Ackman was putting on his large short position. Basically, excess variance is volume looking for its other side. Mm-hmm. So to me, the simple coloration of this condition is a much more ingredient of intelligence. So if you put yourself in a position to do some of your best work when the opportunity for extreme daily variance is happening, and again, this slide was when you would say, I go both ways and I like it. That's what this slide is. Mm-hmm.
I mean, you can go both ways, and you take the short side of a bull market, take the long side of a bear market. You're just capitalizing on that other side that you're trying to get to, and markets get there very quickly. This next slide where you put the dates on is going to remind people of that.
I mean, this literally, everybody can go back and look at the dates and realize, and the point is to go back and say, how did I do during that period? Mm-hmm. Remember, when you and I met in March, even people like Warren Buffett said, things are not going to turn around for a long time. Market went up 32% in 14 days. Eric Schmidt of Google said things will be dismal for another couple of quarters. Google was up 100% by the end of the year. So the challenge is put yourself in a position where you understand information that helps you be objective in your own way. You can incorporate, be consistent, and again, it's all about making sequential better than average decisions. That's it.
Yeah, and that brings you back to the Andy Duke point, which is it's not about making mistakes. Her whole point is what was your decision-making process in those moments of clock time or OODA loop, as John Boyd would say.
Right.
How about on sequence matters? Flow dynamic. This chart is like, I bet you not many people have seen this chart before.
Okay. So once again, this is purely what you and I talk about all the time. It's the persistence of a condition. What would be interesting is if we also ran a column with the quad, coloration for quad. So the idea is when volatility expands, why is the expected range important? Because what I'm looking for is aberrant volume behavior at the boundary. How many times have you and I talked about is the last thing you want to be in an expanding realized volatility environment? You don't want to be uninformed range at the boundary. Yep. As Paul Jones said, you could come in flat, the market could go limit down, you could sell it could go limit up, you could buy it could close flat, so there's no volatility to speak of and you lost the range. Don't do that.
Don't be the uninformed volume. That's one of your best one-liners, man. On this next one, what's up with the 42,000? What was it? Why is there a dollar number on this?
I'm sorry. That's Bitcoin. So the point Bitcoin. Of this, that's the Bitcoin. So and this is from Saturday morning at 6:34. So the point is, I use the same series of graphics, the same computation, because my eye likes looking at the same values across all the different products. So it allows you, and by the way, excess volatility in the Bitcoins is off the chart, excess daily variance.
It's crazy.
So it's crazy. So again, it goes back to the Stan Druckenmiller, what's your point? I found that speaking to important people with numerical inputs is far easier. Let them decide whether it was important or not.
Yeah, I mean, that's why I find Bitcoin actually pretty hard to trade, because those outside moments are
Sure.
frequent. I mean, relative to the prior range. And that's, we do have a daily range product that's actually fairly accurate, but I'm more happy about the accuracy given how hard it is to be even remotely close to accurate on the prior range. You know, it's a crazy thing when you think about it in vol space.
Let's go to the last slide about exponentials. Let's end it on that.
Yep. The last slide in the deck.
Yeah, it should. Oh gosh, I don't know if you have it. No,
Yeah.
that's Bitcoin. Here it is.
Yeah.
So Alan Turing in the 1930s, as they said, was the first person that said there's a discreteness to time and a discreteness to state. And time is simply a continuum of changes in state. That started the current, massive ways of nonlinearity, exponential change. When you think we're almost 100 years into this digital revolution, it's never been more important to understand that exponential, and Mike Green and Josh Wolf, I love Josh Wolf, and literally he's in the exponential investment business. He also is one of the greatest people to talk about how to be careful around exponentials. And everybody should really understand what this means. We're all disconnected from the underpinning of exponential change. We basically live in a human linear world, and some of us get a chance to be slightly nonlinear in some of the things that we do, but we're basically a humanoid that's linear, looking at this underpinning of technological change. And the slides below are simply, again, I'm not disparaging Cathie Wood, and I'm not disparaging anybody that invested in ARK, but the slides are, when you go back between 2017 and now, over 50% of the inflow into ARK, the main innovation fund, came in the 83rd percentile, an average monthly rate of 131. So the ARK promise had gone up literally dramatically between 2014 and 2020, but people didn't get convicted about the need for exponential exposure until the 83rd percentile. And there's another slide that it's not on the deck, that by February of 2001, in looking for the next big thing, the ARK business owned over 10% of 25 different companies. They're now down on average 71%. Since the spring of 2021. Remember when Jim Chanos was talking about the idiocy of TAM and the projections of TAM? I know, but it tastes good, it looks good, and I'm all in it, and I believe in exponential change. And then you got it right in the neck.
Yeah. Well, I mean, if you don't know, first of all, there's a quad for that, right? Exponential functions work. Growth as a factor exposure howls when you're in quad 2, and there's no, again, it's nothing against Cathie Wood. She's just a factor exposure.
No.
She is long hyper growth, high beta, anything, high short interest, because the less believable the TAM or the NAV story, the more hedge funds are there on the short side. She had it all working up until quad 2 ended. And then when quad 2 ended, the market saw through to the next quad, and that's why we use the quad as the fundamental, kind of shining light on the forward outlook. And I think that's a big thing. I would actually love to have her on Investing Summit to kind of go back and forth on that. I think it'd be quite useful to hear how she thinks on the other side of it.
Well, she recently, again, you and I are very practical practitioners, of hard-earned money, getting the right exposure enough over time in order to play to win again and compete tomorrow. Recently, as she was asked about the performance of the innovation portfolio, she said, for whatever reason, we're currently in a bear market for innovation. Well, no, there's always amplitude in the market for innovation. It just so happens that between 2020 and 2021, there was a tsunami of money looking for the highest delta, like the highest possible payoff.
Yep.
And it's just we live in a world where FOMO gets involved with promo, and it's a problem.
Yeah. I don't think people are going to have as many problems. We all have issues, right?
Sure.
But you did a great job. Like, again, I said, they don't teach us this in business school. They should. That should be people's, practitioner school when it comes to, again, rule number one, don't lose the money you have, and then obviously compound returns on top of that pile. Nice job, man. Like, thank you very much for taking the time to put the slides together, because again,
Sure.
they're not slides that you're going to find anywhere else. You're certainly not going to find them in a textbook, because you drew them on the shoulders of those giants that created the many, many books. And that's a great curation, buddy. I mean, I think that this, when you and I are long gone from this game and this world, these types of presentations that some people give, which you just gave, are gonna live a long life. So thank you for that. I'm sure I'm thanking you on behalf of everybody who watched. Thanks for spending the time on that.
It was a pleasure. And all I would say is, in my professional career, it was always a 24-hour-a-day, on-demand, presentation, meaning you were always asked to be able to talk about your risk positions at 24 hours a day. So if the phone would ring at 3 o'clock in the morning, the first question would be, are we waking you up? The first answer was no. And here's what I'm doing.
Yeah.
So this is purely an extension. I hope people found it helpful. I think there's an enormous amount of value in the Hedgeye community, because I've got all kinds of Hedgeye clients that reach out to me, that ask for clarification, that ask for examples. There's a tremendous amount of community spirit, and that's a function of the way you've handled yourself and the team, and what you've achieved over the last 13 years.
Well, thank you. I appreciate that. That's a huge compliment coming from somebody who I have a tremendous amount of respect for. You can see why. And again, the Hedgeye community, it's got real people like Buddy Carter teaching people that better way. We'll be back in a bit with Daniel DiMartino Booth.